So the first thing we're thinking about the elements that you have to have is you have to have a high dividend paying whole life policy. The second thing that you have to have is a lot of cash. So this is a little bit counterintuitive. In order to be able to execute an infinite banking or a bank on yourself strategy, you have to already be someone who can dump tons of cash into these policies. So right there off the bat, that's fairly limiting, right?
Yeah.
Because not everyone has a ton of excess discretionary cash flow that they can throw at this kind of policy. And so the question you may ask is, all right, well, why do I need that? What do I want to be happening with this tons of cash? Well, what you essentially want to have happen is part of the cash you're putting into the policy is going to pay for the premium. The other part, and the premium being what the insurance actually costs, the other part is going to go to building up the cash value. What you want to do by dumping as much cash into this policy as you can is you're buying paid up additions. And what paid up additions are entirely paid for life insurance additions that both increase the death benefit, increase the cash value, and thus increase the dividends that are paid out. So for infinite banking, this paid up addition is primarily used to increase the cash value as much as possible so the dividends that pay on that cash value are as high as possible. No different than if you had a bank account and you want to put as much money into that bank account as possible so that the interest or the dividends you earn on that is as high as possible.
Now, wait a minute. When I watch the brochure commercials, everybody always says you put all this money in, but here's the benefit over investing. You get access to your money completely tax-free. How in the world... I mean, because you're making this thing sound like you're just paying for a lot of life insurance.
That's right.
How am I going to get access to my money tax-free, as I've often hear people talk about?
So when we think about the cash value increase and you're dumping this money in, and we look at the average dividend rate, the 10-year average dividend rate on cash value policies is somewhere around 5 to 6%. Some companies a bit lower, some companies a bit higher. But the thing that makes this exciting or gets people excited about it is exactly what you said. You actually have the ability to take loans from the policy. So if you need money, if you want to access the capital, you can take a loan from the cash value that is, quote unquote, tax-free, where you can then use that money to go consume goods or to go buy products or go do fill in the blank. You are borrowing money from those copious amounts of cash that you've paid into the policy to build up that cash value.
Now, wait a minute, because I'm already, my spidey senses are starting to tingle a little bit here, and the fact that leverage is not something that taking on encumbrances don't tie into financial independence, because those two words, independence, encumbrance, those just don't work. How are you going to make this work where I'm taking loans? Because aren't I paying interest rates on this stuff, Bo? I mean, there has to be a catch here.
That's exactly right. So a lot of these loans do indeed have interest rates that you're paying. Now, before we go into the interest rates that you pay, there are two different types of loans you ought to know about. There are what are called direct recognition loans, which means when you pull the money out, you don't earn any money, you don't earn any dividends on the money that you've pulled out. Well, then there are non-direct recognition loans where you do keep earning dividends on all the cash value, even what you take out as loans. So again, I'm trying to think about this in terms of banking. On direct recognition, if I put money in my savings account and then I go to pull the money out of my savings account, I no longer earn interest on that money that was in there. With non-direct recognition, it's like I can pull the money out, but I'm still getting that. However, you've already alluded to this, these loans do bear interest. Well, if you now have an interest rate you're paying on the loan that's greater than the dividend that you're receiving on the policy, it does not work. It falls apart. So there's another feature, because these insurance companies that think of everything, where they make available what are called wash loans, where you can go take a loan out of the policy and you can guarantee that the rate you pay on the policy matches the dividend rate so that it doesn't flip upside down. But as you can imagine, if you're trying to get one of these policies that has non-direct recognition loans, and those loans even operate as wash loans, what's likely going to happen is either the costs and fees of the policy are going to be greater, or the rate of return they're willing to give you through the dividend rate is going to be lower. There's going to be a cost somewhere.
I've watched a lot of social media. I've never heard a lot of people talking about direct recognition, non-direct recognition, wash loans.
Awfully complicated.
This stuff, I mean, my head's spinning a little bit on this. So, because this is not anywhere that I'm seeing on social media